everyone. Today we're going to talk about the most exciting subject probably in the entire year, insurance, of course. And I know most of you are probably thinking, okay, insurance, that can't be that exciting. But I wanted to talk a little bit about whole life versus term insurance, because usually that's the most frequently asked question. What's the difference between the two? Term insurance versus whole life. Term insurance, and the way I like to explain it is, and I think it'd be the easiest way to understand it is, term insurance is like renting an apartment. You pick a specific term, such as the lease of the apartment. Usually that is the rent payment that you're going to be paying, in this case the premium payment. And when that lease expires, or that term expires for your term insurance, that means sky's the limit. Your landlord can, increase it to whatever they want or boot you out. Same thing with the term insurance policy. That means that if you, let's say you've got a 10-year term, on the 11th year, your term insurance premium can skyrocket to any amount, depending on your age, or they could just say, we're not renewing it anymore. So that is why I say, it's like leasing an apartment. On the other hand, whole life insurance is like buying a home with a fixed mortgage. You at the age that you're at, you lock it in. It doesn't ever increase anymore. And usually by about anywhere between 20 to 25 years, it's paid up. So you can either decide to not pay it anymore and make sure that it's totally paid up, and your cash value continues to increase, and that is what takes your premium. So your premium doesn't, once you lock it in at your age group, like a mortgage, a fixed mortgage, it's locked in, and you can keep it for the rest of your life. Nobody can take it away from you. The only time that you can lose it is, of course, if you lapse your premium. And that is the main difference. And many people say, well, why even bother getting life insurance? Well, there's really a lot of reasons for it. One is if you're a young family, you've got, let's say we have a main breadwinner and a stay-at-home mom, and or stay-at-home dad and main breadwinner, which nowadays it's normal. And let's say you have 4 children, and most of the families will say, well, we can't even afford to get that, and really you can't afford not to have it. And the reason is because if something was to happen to the main breadwinner, how's that family going to survive? I mean, you can't replace the loved one, but at least you can keep them in the same standard of living that the children they were used to. And that is another reason that many times term insurance is a great vehicle to do during that, during a family, a young family that is growing up. Let's say you get a 20-year term, then that means that, hopefully the youngest is at least 20 years old by the time that 20-year term expires, and it's affordable. It's not very expensive. So that is another reason why term insurance is sometimes very valuable for a young family that can't afford a lot. The other reason that a lot of people use it for, or businesses even, is like a key man insurance. You have a business, and there's one employee, or even the owner, that you can't live without, because that person knows everything of the business. So you want to ensure that person has the key man, and you want to ensure, let's say until retirement. So you do it another 10 years, 20 years. Term insurance usually can go anywhere from 5 years to 30 years. Those are the terms that you choose. Of course, the longer the term, the higher the premium, because then that means the insurance company has a longer risk. So for that reason, if you do a 5-year, it's going to be much, much less expensive than a 30-year, because a 30-year locks you in for 30 years, gives you the benefit of knowing that your premium is not going to increase for the 30 years. Now, on the other hand, for whole life insurance, the premiums are usually a little bit more expensive, so most people can afford to buy less. The good news about the whole life is that it's permanent, and also it's increasing, the cash value is increasing, and it's like a snowball effect. The first few years you don't get a lot, but by about the 10th to 13th year, you've broken even. So even if you cashed it in, you had coverage all that time, and basically you get your money back. So that's the good news about whole life. And some people will say, well, you know what, I'm going to use it as an investment. And that's okay, but your investment's not going to be great. It's going to be minimal because usually you don't get very much on the cash value. The good news is that you know that it's something that you're going to keep for a long time. So usually if you're going to use it for estate planning, that's a good time, the good thing to use the whole life, because you're going to keep it as long as you need to keep it. If you're going to use it, again, for even a buy-sell agreement, two partners that don't want, if one partner dies, they don't want to do business with the ex-wife or the kids, they can buy each other out by having each other as the beneficiary. Those are other reasons to use it. For estate planning, for the taxes, because remember on insurance, you pay pennies for the dollar. So it's still a good way to go, as long as you can still do the underwriting. And so I'm going to pass around some forms, and if anybody wants a quote, no obligation, feel free to fill it out and just give it back to me, and I'll be happy to bring some different quotes. And all you have to do is let me know if you're interested in whole life, permanent insurance, or if you're looking for a term insurance policy. Another good reason for term insurance, and I'll close with this, is if you have a huge mortgage and you want to make sure that that mortgage is paid off when you are gone, they use it as mortgage insurance. So mortgage insurance is basically term insurance is what it is. And they use, normally what you do is you get the amount that the mortgage is due. So in other words, let's say you owe $300,000, so you want to get $300,000. Let's say you owe $100,000, then that's the amount that you want to get covered for, so that both spouses or whomever owns can pay off the mortgage and without having to worry about losing sleep or losing the home as well. Any questions? No?
There was a lot of good information.
Yeah, well, thank you so much.